Hi, folks. This is Mike Zlotnik, Big Mike, and today we're going to discuss real estate funds and syndications, subscriptions, and redemption mechanism and related issues. So, as usually, this is for informational, educational purposes only. No advice is given. Nothing is offered to buy or sell. If you are interested to invest in any of our funds, request PPM, private placement memorandum to accredit investors only. Consult with your attorney and CPA professional. Okay, so let's talk about subscription redemption mechanisms to funds. Let's first cover open-ended funds. Really important that there are different mechanisms how things work in open-ended funds versus closed-ended funds or syndication. So open-ended funds are typically known as the evergreen funds. They don't have an expiration date. They raise capital on an ongoing basis. New investors that go in, they subscribe. Investors that exit, they redeem. And subscriptions and redemptions typically happen on periodic basis. So, for example, quarterly. So if folks want to subscribe, they basically reach out to the fund manager, and then they ask for what is the subscription mechanism. They receive a PPM, they review, and then they go through the subscription process. The funds go into the subscription account, and at subscription point, they subscribe to the units of the fund. On the redemption side, typically they request a redemption. So redemption mechanism also works on periodic basis. And what is really, really important is for folks to understand what a given fund invests in, what its asset model. So redemptions, the way they work is you can request a redemption. And if the fund has liquidity, the fund will basically redeem you at a time of redemption. Now, there are a few limiting factors, something really important for folks to understand. Number one, a fund may have a lock-in period. So if you subscribe today and the lock-in period is 3 years, means that in general, you're not allowed to redeem for 3 years. If fund has 2-year lock-in period, it's 2 years. If fund has 6 months lock-in period, it's 6 months. Something to keep in mind. The fact that you are past redemption period doesn't mean that you'll get an immediate redemption. In fact, most of the PPMs will explain what the redemption mechanism is. Some funds will allow you to redeem all the funds. Some will say, well, you can only redeem 50% in year 1 and 50% in year 2. Some will say you can redeem over 4 quarters, right? Those are generally the mechanisms for redemption. Now, the other critical component is the fund's liquidity. So different funds have different mandates. Some funds invest in short duration loans, like hard money loans, bridge loans. Some funds invest in longer duration loans. Some funds invest in defaulted or distressed notes with a multi-year time horizon. Some funds invest in multi-year multifamily projects. Some funds invest in multi-year self-storage projects and other asset classes. Some funds invest in diversified portfolios of assets with multi-year time horizon. So what the key message is the fund doesn't sit in your cash and it's ready for redemption mechanism. The fund maintains typically some amount of liquidity to deal with issues like this, redemptions. However, the fund is not going to sit in a lot of cash because the fund needs to deploy the capital into assets to be used productively. And those assets are not always liquid. Typically, multi-year equity investments are highly illiquid. Certain debt investments may have some liquidity. Some assets can be sold. Some assets cannot be sold. And this is something to keep in mind. So an open-ended fund may have ability to redeem in the normal course of business a certain amount of redemption. But if more people all decide to get nervous and request redemptions at the same time, the fund may have to create a redemption queue and redeem people gradually over time as liquidity becomes available. This is something important to keep in mind. It doesn't mean the fund is in trouble. It doesn't mean the fund is doing badly or doing well. It's just something that the fund may maintain certain level of liquidity. What is that level of liquidity? For example, fund may maintain 5% liquidity. Fund may maintain 10% liquidity. Fund may maintain 3% liquidity. So if a fund maintains 3% liquidity and suddenly 10% of investors want redemption, you can imagine what happens. The fund can't redeem it. It's just the redemption mechanism says, well, folks can request redemption, but the fund manager can stop the redemptions or defer them over time just because he doesn't have the cash, he or she doesn't have the cash to redeem. It's something important to keep in mind. So understanding what the fund invests in, its asset model, may help you understand what is going to be the availability of your funds to redeem. Also, something interesting happens. When everything is great, nobody wants to redeem. when a little bit, like we are now recording this during a period of expected recession, some investors get nervous, and more investors get nervous. And it's not run necessarily on the bank. The banks can experience a run when everyone just wants the deposits out. For a bank, it's call FDIC, call Fed, Federal Reserve Bank, get emergency funds, otherwise they insolvent. For syndication, for a fund, for an open-ended fund, it is simply create a redemption queue and redeem people gradually over time as liquidity becomes available. Something really important. Some funds, if they have assets impaired, meaning that promissory notes that defaulted and they are now in foreclosure, or the fund has investments that are struggling, the fund manager can suspend redemptions because they are concerned about the well-being of other investors in the fund if they redeem folks that want to exit. So all these things are important to keep in mind. Nothing is particularly, it's not a guaranteed redemption mechanism, something to keep in mind. Now, those are open-ended funds. Closed-ended funds and syndications, which they work very, very similarly, work differently. So closed-ended fund typically raises capital during the investment period, could be 1 year or 2 years. At some point, it stops raising capital and deploys the capital in multiple deals. And once those deals go through the full life cycle, they exit. That's when the fund can return investors their principal and their profits. Syndication works very similarly, except for typically it's 1 or 2 assets or some kind of a mix of fixed number of assets all being acquired at the same time. And the syndication typically has a time horizon. It's a life of that deal, or if there are more than one deal, could be multiple deals. The closed-ended funds and syndications have no redemption mechanism. So subscription works like this. Subscription, if it's a syndication, you decide to go in, you subscribe, you wire in the funds, syndication closes, the money is in the deal. There is no redemption mechanism in syndication. Closed-ended fund, you subscribe, the fund may not immediately need the money. They'll call the money when it's needed. It's called capital call. So a closed-ended fund will issue a capital call saying, Mr. Investor, we're ready to take your money. When the money comes in, money goes to work on a deal or multiple deals. Once all investors' capital is deployed, the fund is closed, all these assets have to go through their life cycle. Typically means they are bought, they are improved, they're managed, they get to a point of sometimes a refi, and then further cash flow from that point, or sometimes it's a sale, right? Eventually everything gets sold, and eventually these funds close, and all the money is returned to investors in the form of preferred return of capital, and then profit split. So those are the mechanisms. Closed-ended funds and syndications in general do not have a redemption mechanism. You are in that fund for the life of the fund. Is this bad? Absolutely not. It's neither good nor bad. This is how they work. So when you invest in a closed-ended fund or a syndication, you absolutely have to be prepared to be in the fund for the life of the fund. Now, some folks have asked me the question, can I exit a closed-ended fund or a syndication ahead of the fund or syndication going through the full life cycle? And the answer is, you can try. The way it works is as following. Let's just say you have a situation in life event happens, God forbid something bad happens, and you need the liquidity. What do? But the fund is not ready to exit, or the syndication is not ready to exit. That point of time, you can approach your friend, another investor, and say, hey, I have a position in this deal. I put in $100,000 in this syndication, and I need to be out. Would you be interested to step into my shoes, basically buy my position? But to be clear, it's not, you can't just go sell it. It's not a transferable investment. It's a restriction that you have, generally a part of the subscription. Typically, you have to approach the manager of the syndication of fund and say, I have a new investor who's ready to take over my position. I need an exit because, God forbid, my cat died. I'm sorry, I'm using this example. I have a cat, and you have an life event. Something really bad happens, and you need the liquidity. So what do? You basically bring that investor who will step into your shoes to the fund manager and say they are a great investor, just like me. They're ready to subscribe, and I worked out a deal with them. And the deal is I put in 100, and they're ready to buy it at 100 par, and I'm foregoing all my upside. Something like this. This is generally how it works. You just need to be prepared that if you are going to have somebody else who's going to come into your position. They may not offer you full fair market value of the investment. They may ask for a discount. And that is a normal market condition. If the market is doing well, you may actually be able to sell your investment above par. You put in 100, the investment may be worth at this point of time when it exits 200, and right now you're willing to take 150 and they're willing to pay you 150, right? So you can have a private transactions in a manner of speaking with the approval of the fund manager. With the closed-ended funds, similar mechanism, right? Somebody else would be taking over your position if they're willing to do that at whatever price that the market will bear at that point of time. If the investment is distressed, they may say, hey, listen, you put in 100, I'm only willing to pay you 50. This is just an example of what can happen. It really depends on the circumstances. But the transfer mechanism is generally prohibited, although the fund manager can make an exception and allow a transfer. And sometimes these transfers are absolutely for the reason of traditional IRA conversion to a Roth. That's a legitimate transfer, right? Or somebody needs to transfer into a family trust. These events are generally normal transfer mechanisms. They don't require somebody else stepping into your shoes, just a family planning or something like that. But redemption does not exist in closed-ended funds, closed-ended syndications. So just something to keep in mind when you're evaluating an investment, any fund, whether it's an open-ended or closed-ended, you have to absolutely dig through the fund asset model, the fund PPM, talk with the manager, understand typically how they run their business, what kind of assets they invest in, how liquid these assets are, and what's the time horizon. For an open-ended fund, it matters because you may need a redemption. For a closed-ended fund, it doesn't matter. The investment, it generally has no redemption mechanism. So having good understanding of what you invest in is a critical part of an underwriting and review, and making sure that your goals, your time horizon, your liquidity requirements are met by a given fund or syndication. Again, if you're looking for liquidity, the long-term real estate funds that invest into multifamily, storage, industrial, shopping plazas, and so on and so forth, may or may not be the right match for your investment. Or you may choose to put some money in these funds and syndications, and then the rest of the money that you need better liquidity in could go into U.S. Treasuries or cash or some other mechanisms that are liquid. So something very important, that the liquidity availability, liquidity requirements are an important consideration in making an investment decision. If you want to be able to redeem in 6 months and the fund has 2-year lock-in, it's no good. If you want to redeem potentially in 2 years, after the lock-in period is over, and you're prepared to stick in the fund for longer than 2 years in case the fund doesn't have the liquidity, that may be a worthy consideration. Again, the fund target returns, risk profile, asset model, everything else are separate from the redemption mechanism. But the redemption mechanism is influenced by the fund investment strategy. So again, not trying to confuse you, but just trying to give you good understanding how the funds function and what they do. So once you understand these mechanisms, when you write a check into the fund, you will go with the eyes wide open. You'll understand what it does, that it's projected to generate you strong distributions, great risk-adjusted returns, tax efficiency, whatever other benefits. But access to liquidity, ability to exit a fund through a redemption mechanism is something that you have to think about, you have to be aware of, you have to be prepared for an open-ended fund having whatever redemption mechanism it has, and a closed-ended fund and syndication having no redemption mechanism. Hope this was helpful. I appreciate your time and attention. Thank you.